Right, so let's put this into terms of a put option. It's a wonderful, endless world of fun and opportunity.
Sounds
Brilliant.
good. I can't wait.
Today we're going into the exciting world of options.
Yes, I'm really looking forward to it. This is an exciting, we talk about options a lot here in the UK markets, and yes, I'm excited to learn how to trade them myself.
Right, we're going to look at calls and puts. Okay. Now that they make up the world of options. Have you ever traded an option before?
No, I haven't.
Have you ever bought car insurance before?
I have, yes.
Well, in that case, you pretty much have traded a put option.
Okay.
Right. Now, the reason that we call it a put option is because you are putting your risk onto somebody else.
Okay.
So walk me through your the discussion you went through to get that car insurance.
Well, basically, when I'm thinking about insurance, I think about like what is the premium that I have to pay. So how much am I paying, and then what am I getting for that premium? So, you know, once I have the insurance, like what is the excess should something happen?
And let's just say your car is worth 20,000. What are your premiums for car insurance?
Like how much do I pay a month? I think £500-600 a year.
Yeah. Okay, so let's say £500. What goes into the company deciding what they're going to charge you?
Well, I think that they look at how risky we are as drivers. I think that they look at the value of the car. So if we had, you know, a brand new, I don't know, like Lamborghini, the premium would be higher.
And what about excess? Do you know what excess you have to pay? So excess being, of course, the car is worth 20,000, but you promised to cover the first.
I think it's around about £100 or £200.
Oh, right.
Something
So
like that.
quite a small excess.
It is, yes.
Right. So let's put this into terms of a put option. So your car is a Volvo. Let's say you've swapped that for, let's just say there was a Volvo stock.
Okay.
Right. So instead of having £20,000 of a Volvo car, you got £20,000 of a Volvo stock.
Okay.
Right. Now, at some point, you will decide, right, I am prepared to lose the first £200 of losses, right? So that's your excess.
Yes.
So you come from where the stock is currently trading down to a strike, and you choose a strike where you want to be covered from.
And that's the strike price.
That's the strike price, exactly.
Okay.
So if the value of that stock drops through that price on a specific date in the future, right? So car insurance you're covered for a year, and then it expires.
Yeah.
So you can choose 1 month in the option, you can choose 3 months, you can choose 6 months, you could even choose 12 months.
Can I choose longer than 12 months, or no? Is that generally the longest?
You can, but it wouldn't really make sense because you're paying a lot of something called time value.
Okay.
Okay, so instead of, I think what your question is, if you want to just be covered and forget about it, then what you do is you roll it and you keep on rolling the protection.
I see.
But essentially what you're doing is you're paying a premium to cover the value of your asset. Because the value of your asset is 20,000. You might choose, you know, the first 1,000, you don't mind. Because that's just, you know, a stock can go down 5%. That's just the way it is. But then you're prepared to pay 2% to make sure that anything below that, you can give the risk to somebody else.
Okay.
At any point for the next, 3 months. So that's all a put option is.
And am I right that I'm giving the risk to somebody else, but actually if I exercise it, I'm selling those shares, so I don't have them anymore, right?
That's exactly right. So you have purchased an option to sell those shares to somebody else, at a specific price on a specific date.
Okay.
So, for example, if you had we've talked about Kingfisher, right?
Yes.
So Kingfisher, to protect yourself, you might have bought March 2025, £2.50 put.
£2.50. Okay.
So the stock's trading like 257, I think.
Okay.
Let's get an update on where Kingfisher is so we talk exactly. Yeah, Kingfisher, oh no, it's trading at 250.
Okay.
Right, but when we looked last week, it was trading at 257. So you would say, okay, I'm nervous. I want to buy a put option in Kingfisher at the price of 250, the strike of 250. So anything below that, it's somebody else's problem. Now, if it goes through 250 before the expiry, then the option would probably be worth more. Okay, so let's say you bought it for 3 pence.
Okay.
Right?
3 pence per share. Is that
exactly right?
Okay.
So that's just over 1%.
Okay.
If the stock drops 20% or 10%, then the option gets worth more and more.
So I can, I guess, do 2 things. I can either sell the option to someone else.
That's right.
Right? Somebody who needs it more than I do, maybe. Somebody who bought at £3 or 3.50, and so that option is going to be worth more to them than it is to me. Or I can just wait until my exercise date and sell it and sort of then balance out my portfolio that way.
There's a whole range of options. What you could do is you could roll the strike down to 230, and you would take a lot of profit out of the 250, but maybe you want to keep your stock, So you might roll the month. You've got a March option at the moment. You might roll that to June.
So you're telling me options have options?
Exactly. And that is it. It opens a whole new world of optionality.
Okay.
Right? And it's so exciting because there's so many things you can do in this world. It really, we've looked, at the sort of the basics, the primary school of trading up until now. This is secondary school.
I see. And that makes sense, actually, because we had the limits and the stops. And so, but it sounds like this gives you a lot more optionality, as you say. And so you can be more sophisticated in what you do rather than just trigger a closing position.
Now, if a stock like Tesla or Nvidia or those crazy stocks that move up and down and up and down, they're regarded as higher volatility. So everything that goes into it, it's the price, the strike price, the amount of time to expiry, so that's the time value of an option, and the volatility.
Okay.
Right? So it can have intrinsic value and it can have extrinsic value. But we'll come on to that another time. Now, that's protecting to the downside. A little bit harder to explain is what a call option is. Right? Now, it's easy to say, it's just the reverse of that. But I want to put it into a common day analogy for you to think about as well.
Okay.
So you mentioned you lived in Clapham.
Yes.
Right. Now, that reminds me when Battersea Power Station was being developed.
Yeah.
Right. It was going to take years. I think it was 10 years in the end it took. And of course, the developers need investment to work with just for cash flow. You could put a deposit down of, I think, about £20,000, and that gave you the right, but not the obligation, to buy an apartment in Battersea Power Station when it was finished for £500,000. For that 20,000, right, you had the optionality on Battersea Power Station being a success, which is stunning. You had the optionality in UK property prices if they jumped.
Yeah.
You could have locked in that price. And that's pretty much what a call option is.
The 20,000 in this example goes, right? That's the price the price you pay.
You could actually sell it on to somebody else.
Oh, okay.
Yeah. So that option in itself would have value as well. So it's not a deposit as such that it just goes. Yeah.
Cool.
Yeah, choose a stock that you think might have upside, but you don't necessarily want to buy it right now.
Okay, then I would pick Microsoft.
Okay, yeah, Microsoft is absolutely perfect example.
So I'm not sure what the viewers know already, but TastyTrade is a business that we bought based out in Chicago, and it is a US listed options trading business. And also, it has a really cool content arm called Tasty Live, where they've done just an amazing job to bring the concept of options to the forefront of people's minds in the US and really shown them how options can help enhance their investment portfolios.
And now you can see the platform as well, which I've pulled up here. So very simple to use. I know it's a lot to look at, right? This is the great thing that they've done. They've managed to get everything you need onto one screen. But what I would like to take you to is a trade in Microsoft. So let's go to really easy to find it, as you can see.
Yeah.
Now, Tom and the team think that 45 days to expiry is the optimal time to put a position on.
Okay.
For all the time decay and everything like this. So if we open that one, then you can see all these prices. Now, Microsoft is currently at 423.
Okay.
So where might you want to buy in the future? You know, if it starts to go up, then maybe you want to jump on that train.
So it's at 423 now. So I think that for me, what's realistic in a 45-day time period is maybe 450.
450, perfect. And then where might you want to sell it?
Ooh.
If it went up to 450, 470, would you be happy with 4%?
Oh, yes. So I would. So I'd buy it 450 and then sell it 470.
Exactly. So there, if we bought it 450, right, I've clicked on that one. So that shows you buying a call option. That is, I remember, look back to our Battersea Power Station example. You are paying a deposit of $3.30.
Okay.
For the right, but not the obligation, to buy the stock at $450.
Okay.
Okay. So you're paying $20,000 for the right, but not the obligation to buy an apartment in Battersea Power Station for $500,000.
Okay.
Exactly the same, right? Now, what you can do as well, because $3 is still quite expensive, right? You might want to say, but if it goes higher than 470,
yeah,
that's all I need for it. So you can sell that one. So there's that optionality again, right? You can, yes, you pay $3.30 to buy a call, but also you receive, okay, you can actually sell options as well and receive money for selling options.
Okay. And that's the price right now, but that might change tomorrow or the day after, right?
Exactly. Yeah.
So that might go up.
Option prices change and the stock price changes, and that's why it's called derivatives, because the price is derived from the underlying stock price, from the price of volatility, the number of days. So yeah, that is the world of options. It's a wonderful, endless world of fun and opportunity.
Yes.
It's really worth, getting our teeth into, because next week we're going to make our first trade.
Sounds
Brilliant.
good. I can't wait.